In this module, the final module on mortgage-backed securities, we're going to discuss prepayment modeling and the pricing indeed of mortgage-backed securities. We'll see an example of a prepayment model and we'll see some of the factors that go into a prepayment model, but we will also mention that there are very few prepayment models that are available in the public domain. When it comes to pricing mortgage-backed securities, it is a very difficult exercise. We need to use Monte Carlo simulation typically to price these securities. They're very complicated and they're very computationally intensive to price. So we will just be discussing the big picture here, a little bit about prepayment modeling and a little bit about the pricing of mortgage-backed securities. In many respects, the prepayment model is the most important feature of any residential mortgage-backed security pricing engine. Term structure models, which are also required to price mortgage-backed securities, are well understood in the financial engineering community, but this is not true of prepayment models. For example, we can think of our binomial model that we saw that we use to price fixed income derivatives. That's an example of a term structure model. And there are many term structure models that are out there in the quantitative finance community. They're well understood and people understand how to work with them. A mortgage-backed security is exposed both to interest rate risk, which is why you need a term structure model, but also it is exposed to prepayment risk. And so you will also need a model of prepayments, a model of how homeowners in the underlying mortgage pools of how they are going to prepay. So a prepayment model is also very important when it comes to pricing mortgage-backed securities. The problem is that there is relatively little publicly available information concerning prepayment rates. So it is very difficult to construct good prepayment models, accurate prepayment models, and to calibrate these prepayment models as well. In other words, to figure out what the correct parameter values are inside these prepayment models. One very well-known publicly available model is due to Richard and Roll from 1989, and they model the conditional prepayment rate, the CPR, whose definition we recall. The CPR is the rate at which a given mortgage pool prepays. It is expressed as a percentage of the current outstanding principal level in the underlying mortgage pool. It is also expressed, by the way, as an annual rate. And we have seen that before as well. So let's take a brief look at this model due to Richard and Roll. I want to emphasize that the vast majority of the prepayment models that are out there are private. They are not published. Nobody knows what they are. They're just used by banks and other investment companies who invest in mortgage-backed securities, and they don't share their models with other people. So it is very difficult to find good prepayment models that are out there in the public domain. So this is the prepayment model of Richard and Roll. It looks very complicated, but I don't want anybody watching this video to think that they need to understand everything inside here. The idea is just to give us a sense of how one might go about constructing a prepayment model, and in particular a model for the CPR. So this model of Richard and Roll assumes the following. So they assume that the CPR time K is equal to the RI, which is the refinancing incentive, times the age, which is the seasoning multiplier, times the MM, which is the monthly multiplier, times BM, which is the burnout multiplier. Now, what are all of these factors? Well, the refinancing incentive is something we've discussed before. Let's not worry about the form of this here. Really, that's not relevant. The only point I want to emphasize here is this. WAC, if you recall, is the weighted average coupon in the underlying mortgage pool, and RK10 here we're assuming is the 10-year spot interest rate. Now, why is this difference relative? Well, remember we said that homeowners have an option to prepay their mortgage. So, for example, suppose the weighted average coupon was, let's take an example, suppose WAC was equal to 10%. And suppose RK, in other words, the 10-year interest rate at time K was equal to 3%. Well, then this difference here is 7%, and it represents how much money homeowners could make by prepaying their mortgage and refinancing at a lower interest rate. Now, they wouldn't be able to refinance at 3%. This rate would be too low. But maybe they'd be able to refinance at R plus 2%, which would be 5%. So therefore, they could prepay their mortgage, on which they're currently paying 10%, and refinance at 5%. That would be a large gain. So this number here, WAC minus RK10, represents the incentive to refinance, and that's why we call it RI. And so the larger this number is, the more prepayments you're going to get. So in fact, this number here, although it might be difficult to see it when you've got this inverse tan function, but this RIK here will increase as WAC minus RK10 increases, and therefore it will increase the CPR. Age is what's called the seasoning multiplier. So again, T is measured in months, and it's a minimum of 1 and T over 30. This is just meant to capture the fact that early in the lifetime of a mortgage, a homeowner is very unlikely to prepay. After all, if they've just taken out a mortgage, maybe it's because they've just bought a new home, it's very unlikely they're going to be moving home in the next year or two, and therefore we said age equal to the minimum of 1 over T30. So when T is just 1 month or 6 months, this number here is very small, and so it multiplies in here to give a very small CPR in the early life of a mortgage pool. MM is the monthly multiplier, so it's approximately equal to 1. There's a different number for each month, January through December. They're all close to 1, but some of them are less than 1. And some of them are greater than 1, and this is just used to reflect the fact that people tend to prepay at different times of the year. For example, there tends to be more activity in the housing market in spring and summer, for example, than in winter. And so in winter you'd have a number, in the winter months you'd have a number less than 1, and maybe in the spring summer months you might have a number greater than 1. So this is the monthly multiplier. And then BMK is what's called the burnout multiplier. So for example, in this case we could say BMK equals 0.3 plus 0.7 times MK minus 1 over M0. So for example, this is equal to 1 when K equals 1, and it's equal to 0.3 when K is, well, approximately N, close to the end of the mortgage. And what this is reflecting is the following. So early on in the life of the mortgage, this burnout multiplier is equal to 1, but it decreases linearly through the life of the mortgage and falls to 0.3 at the very end. And this is just used to reflect the fact that people who can prepay tend to prepay early. For various reasons, there are some people who have houses who can't prepay or who don't want to prepay, and those people, if they haven't prepaid early in the life of the mortgage, then it turns out that they become increasingly less likely to ever prepay. And so that's the burnout multiplier. Now, as I said at the beginning of this slide, don't worry about the details. I just want to give you an example of how some people might go about modeling this conditional prepayment rate. By the way, another comment, in the spreadsheet, in the worksheets in the Excel workbook that we've looked at so far, we always assumed the CPR was deterministic. We used the so-called PSA benchmark. I mentioned that in the real world, of course, the conditional prepayment rate will be random. It will depend on what's going on in the economy. And certainly that randomness is captured, for example, over here. The 10-year spot rate at time K is random. So certainly the refinancing incentive will also be random. So again, just emphasizing the fact that in the real world, the cash flows associated with mortgage-backed securities are indeed random. How about choosing a term structure model? Well, we also need to specify a term structure model, i.e. a model like the binomial model, the Black-Dermot-Toy model, or Holt-Lee model, for example, that we use to price fixed income derivatives, in order to fully specify the mortgage pricing model. The term structure model will be used to, 1, discount all of the mortgage-backed security cash flows in the usual risk-neutral pricing framework, but also to compute the refinancing incentive according to 15. Whatever term structure model is used, it is important that we are able to compute the relevant interest rates analytically, for example, R10K in the prepayment model of Richard and Roll. Such a model would need to be calibrated to the term structure of interest rates in the marketplace, as well as to liquid interest rate derivative securities like caps, floors, swaptions, and so on. The actual pricing of mortgage-backed securities then requires Monte Carlo simulation. It is very, very computationally intensive. Analytic prices are not available. So the point I want you to take away from this slide and this module more generally is that the pricing of mortgage-backed securities is very complicated. It takes an awful lot of work, an awful lot of modeling, and it is very computationally intensive. You don't have to worry about the details I've mentioned here. As I said before, I just want you to understand the big picture of what is going on. Finally, let me say a little bit about the financial crisis. The so-called subprime mortgage market played an important role in the financial crisis of 2008 and 2009. Subprime mortgages are mortgages that are issued to homeowners with very weak credit. The true credit quality of the homeowners was often hidden, and the mortgages that were given to these subprime homeowners were often ARMs. Remember, an ARM is an adjustable rate mortgage where the mortgage rate is reset periodically. Well, the adjustable rate mortgages that were given to subprime homeowners often had what were called teaser rates. In other words, the initial mortgage rate was very, very low, and that was used to attract new homeowners, to encourage them to take out mortgages that maybe they should not have been taking out in the first place, because the very initial low rates made them easy to service, easy to make the payments in the earlier life of the mortgage. But after 2 or 3 years, these teaser rates were replaced with much higher coupon rates, and so became much harder for the subprime homeowners to pay these higher coupon rates. The financial engineering aspect of the MBS-ABS market certainly played a role in the crisis, particularly when you combine this with the alphabet soup of CDOs and ABS CDOs and so on. We actually will discuss CDOs later in this course. So the financial engineering aspect certainly played a role. The securitization that took place became very, very complicated, and it became very difficult to understand some of these very complicated securities. And also, because these securities became so complicated, the models that were used to price these securities also became very difficult to understand, and people started to lose trust in these models as well. So certainly financial engineering played a role in the financial crisis. But it has to be said there are many other causes as well, including the moral hazard problem of mortgage brokers. What is the moral hazard problem? Well, the moral hazard problem is the problem of getting people to behave the right way. If they're given incentives to behave in the wrong way, they may well end up behaving poorly. So, for example, some of the mortgage brokers that sold these mortgages to subprime homeowners, they weren't careful about checking the paperwork and the creditworthiness of these homeowners. And the reason they weren't is they weren't going to be holding these mortgages themselves. They were going to be selling these mortgages on to other groups, other agencies, other banks who would hold the mortgages via mortgage-backed securities. So they didn't have to worry about the subprime homeowners, for example, defaulting on their mortgages. That would not be their problem. And so that is the moral hazard problem I'm referring to. Ratings agencies also faced moral hazard problems. The problem with rating agencies is that they were rating mortgage-backed securities and asset-backed securities more generally for the banks that were creating them. So they were being paid by banks to do the ratings. Well, obviously there was a moral hazard problem there as well. There was inadequate regulation, inadequate risk management, and poor corporate governance in general. So there were many, many parties to blame for the financial crisis. Certainly some of the financial engineering behind the very exotic and complicated mortgage-backed securities and asset-backed securities shares some of that blame. But certainly I would say these other sources here were very much responsible as well.